Assalamu alaikum everyone. My name is Maher Asiri, and I'll be introducing the two giants in the Saudi telecommunication industry and provide a brief overview of our focus companies. Later on, my colleagues Ma'an, Ali, and Yazid will perform the financial analysis later on in this presentation. First, we will start with the industry and the company overview. Saudi Arabia has one of the largest and most advanced telecom markets in the Middle East. The sector plays a key role in achieving Vision 2030, which emphasizes digital transformation and smart cities and widespread 5G adoption. The country enjoys very high mobile and internet penetration, reaching nearly 170%, meaning that one average people use more than one active mobile line. Government support for cloud computing, digital infrastructure, and data centers continues to strengthen the sector. The three main operators in Saudi Arabia are STC, Mobile, and Zain KSA, with STC being the leading the market, followed by Mobile as the second largest provider. Starting with the Saudi telecom company, aka STC, founded in 1998 and headquartered in Riyadh. STC is the largest telecom operator in Saudi Arabia. It provides mobile, fixed line, broadband, and digital services to both individuals and enterprises. Beyond traditional telecom operations, STC has diversified into cloud services, cybersecurity, fintech, and data centers through its subsidiaries. The diversification supports the company's strategy to transform from traditional telecom provider into a digital service leader across the region. For the strategic priorities of STC, according to STC's 2024 annual report, its main priorities focus on several key areas. First, digital transformation, which aims to expand digital platforms and business-to-business solutions under its Dare 2 strategy. Second, network leadership, with continued investment in 5G and fiber optic infrastructure. Third, asset optimization, particularly through Tawal, its tower subsidiary, and partnerships with the Public Investment Fund. SCC also emphasizes financial discipline, ensuring stable returns and consistent dividends, while continuing to invest in emerging technologies and regional expansion. Now we move to the second company, Mobile, officially known as Ittihad Etisalat Company, founded in 2004 and also headquartered in Riyadh. Mobile is the second largest operator in Saudi Arabia. It provides mobile services, fixed broadband, and range of ICT enterprise solutions. While STC leads in overall scale, Mobile has built a strong position in the consumer mobile market and is rapidly expanding into the corporate and digital business segment. For the strategic priorities, Mobile's current strategy prioritizes as reported in its 2024 annual report, emphasize growth and efficiency. The company is focusing on expanding its enterprise and digital services, including ICT, cloud, and managed business solutions. It continues to invest in network upgrades, particularly 5G and fiber connectivity. Another key priority is operational efficiency, optimizing costs while maintaining profitability. Mobile also aims to diversify revenue sources beyond mobile services and enhance the customer experience through quality and loyalty programs. In summary, both companies operate in the same market but follow slightly different paths. SCC focuses on scale, digital ecosystem, expansion, and regional investment, while Mobile targets enterprise growth, operational efficiency, and improved service quality. Both are aligned with the Saudi Arabia Vision 2030 goals and contribute to the digital transformation of the kingdom. This is my part. and we will continue with my colleagues.
Okay, thank you, Maher. My name is Maher Hijari, and I'll do financial overview for companies. As Maher mentioned, the Saudi telecom market is led by two major players, SEC and Wiley. My part, I'll focus on their financial performance over the past 2 years and highlight some key trends that shows how each company has been performing in terms of growth, profitability, and financial strength. So let's start with SEC. This table summarizes its key financial metrics for 2023 and 2024. SEC's revenue grew by about 5.7% year over year, reaching nearly 75.9 billion riyals. Its net profit increased sharply by 85%, mainly due to one-off gain from discontinued operations, meaning part of that growth come from exceptional items rather than ongoing operation. Meanwhile, total assets stayed relatively stable and shareholders' equity increased from 79 billion to 89 billion riyals. That rise in equity reflects strong retained earnings and a healthy balance sheet position overall. So now, looking at Mobile, we see a different growth story. Revenue rose by 8.6% from 16.8 billion to 18.2 billion riyals, showing stronger top-line expansion than SEC. Net profits grew by 39%, driven by real operation efficiency improvement and better cost control rather than exceptional gains. Like SEC, total assets remained stable while shareholders' equity strengthened, showing that Mobile is also retaining profits and proving its financial resilience. So, when comparing both companies, Mobile shows steady organic growth from efficiency and stronger operations. SEC large profit jump reflects one-off items, but underlying performing remains solid. And importantly, both expanded shareholders' equity, which signals long-term financial health and confidence. So overall, while SEC maintains greater scale and stronger equity, Mobile results highlight consistent operational improvement and growing competitiveness. This covers the financial performance overview of both companies, SEC and Mobiles. Now, to build on this analysis, I'll hand over to Yazid, who will discuss the comparative growth matrices and investor applications in more details. Over to you, Yazid.
Bismillahirrahmanirrahim. Assalamu alaikum wa barakatuh. My name is Yazid Ali, and today we're going to discuss the final ratio analysis between the two companies STC and Mobile in the Saudi telecommunication industry. So starting off, this is the table of contents that we're going to discuss today. The data sources, calculated ratios for both companies. Also, we're going to do a little interpretation by ratio and the key implications by this interpretation. The data sources and assumptions. All the numbers come from the audited annual reports of the companies for the both years 2023 and 2024, and the ratios that are used in this report are globally countable. Here are the ratios that we used in this report: ROA, ROE, net profit margin, current ratio, and quick ratio, in addition to debt to equity, assets turnover, and inventory turnover. The calculated ratios for STC between 2023 and 2024. As you can notice in this table, the ROE and ROA and the net profit margin all witnessed a huge increase since the profits in this year have majorly increased. The net profit and the equity, which made these three ratios increase. Also the quick ratio, the current ratio, the current liabilities went down and the liquidity improved, so they also improved. While the asset turnover and the inventory turnover didn't really witness that much of a change because there wasn't much inventories and most of the inventories were small. Moving on, here's the calculated ratios for Mobile's company. As you can see in the schedule, the three ratios that are affected by profit didn't have a very high change. As you can see, the difference between these percentages isn't really big. Talking about from 12.6 to 16.4, from 13.3 to 17. So Mobile didn't really witness a huge change in profits, even though it still increased. Meanwhile, the current ratio and the quick ratio are really low. They're less than 1 because the inventories are small, liquidity is tight, also the working capital is tight. The debt to equity, it dropped since their debts it dropped, just like STC. Their debts were or their liabilities fell, so it improved, or which means it was reduced. Asset turnover and inventory turnover, especially the inventory turnover, it grew majorly because there's like very small inventories, but a lot of them, so there was a high turnover. So here we're going to talk about the short interpretation by ratio between these two companies. In the profit side, STC has larger increase than Mobile. As you can see the numbers and the difference between the years. STC is way higher than Mobile in ROA, ROE and net profit margin. In liquidity, STC is currently above 1.8, which makes it a comfortable short-term ratio. Meanwhile, Mobile is less than 1. Short-term liquidity is like much tighter than STC's. And the debt, they both improved equally, or their liabilities fell in an equal rate. Efficiency, both firms have similar scores, although Mobile is higher because inventories were small in comparison to the costs. So let's talk about the implications. STC looks stronger on the profit and liquidity side, although some of its profits is because items are disclosed separately, which should be excluded. The solution for it should be by adjusting the profit metrics when it comes to comparing peers. Mobile is better at operational improvement side, but it definitely needs to work on the capital current ratio, which is less than 1. The industry's ratio needs 3 adjustments: to benchmark ROA, current ratio and debt to equity against the total sector averages, and adjust the profitability role that exclude discounted gains for STC to make a fair comparison between it and the other peers or companies. These are the references that I use in this report, and thank you all for listening.
Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Ali Al-Beshi, and I will be doing financial benchmarking and industry comparison. First, what we did was finding the industry average for the return on equity, which was 18%, and we converted it to the STC, which was 27.6%, and Mobile's return on equity, which was 16.5%, which means that we can interpret that STC is doing well above average, as we can see, and Mobile is slightly below. Second of all was the current ratio. The industry average for it was 1.15, and for SCC it was 1.87, and for mobile it was 0.91. This we can interpret that CC is strong liquidity and mobile is less than 1, meaning that it has tight short-term cash. After that, we have the debt to equity, which was 0.72 for the industry average. And for STC, it was 0.76. And for mobile, it was 1.04. As we can see that STC has a balanced leverage, not so much high. It is in the balanced range. But for mobile, it is 1.04, which is high leverage, which will mean at high risk, having all your money from debts, which would be a high risk, but it has high potential. So after that, we have the investment recommendation. Of course, what we recommend is STC Saudi Telecom Company for 4 main reasons. First one was profitability. CC's return on equity, 27.6%, is above the sector mean, 18%, showing greater returns to shareholders, which all shareholders want at the end. Second of all, liquidity. Current ratio 1.87 exceeds the industry average of 1.15, confirming strong short-term solvency and cash management. 3. Operational efficiency. Asset turnover and inventory ratios match industry standards, but what SCC differs from mobile is it converts its revenues into profits more effectively than mobile. And 4. Risk versus return. Lower leverage and strong liquidity reduce risk, and also having high profitability resulting in strong returns, which is a favorable balance for all investors, of course. And that's it for our assignment. Thank you very much for listening.